This is Chanel Bunger with the Becker Private Equity and Becker Business Minute podcast. And today I'm speaking with recurring guest, Rick Kess, partner at RSM, to talk about some trends that he's watching in the private equity space. Rick, how are you doing today?
I'm doing great. Thanks for having me, Chanel.
Great. And what are some of the things that you're watching currently?
Yeah, Chanel, I think, RSM, we cover the middle market. So, typically firms with about 100 million or so of revenues to, 2 to 3 billion, maybe approaching five, depending on the industry and segment that they're in. But, in that area of the world, that represents about 40% of the US GDP. So a big percentage of the companies in the United States kind of fit in that space. And what we tend to follow is really what some of the bigger companies are doing to see if that's kind of either an indication of what the middle market might do in the future or other macroeconomic trends. So, jobs, inflation, interest rates, those items are things that we consistently monitor and watch and try to think about how they impact our clients. And, obviously the job market is continuing to be a challenge in the middle market, specifically in the service sector, healthcare services, and other areas. Um, I think part of the problem there is, we had some people retire perhaps earlier than we had initially expected during COVID, and some people just didn't come back to work, and because of that, we're seeing a big challenge on margin for companies that rely heavily on labor. So, I cover healthcare specifically for the firm, but obviously there's counterparts that I work with that cover other industries. But within healthcare, margin is extremely compressed because of the rising cost of labor. And I think we're starting to see some of that ease a bit. I think there was some early data that I saw yesterday from the last quarter of 2022 that saw a little bit of easing on wage pressure. But we'll see how 2023 continues to evolve there. The employer is still, seeking more people for spots than the employees that are out there from a supply perspective. So that still continues to be a bit of a challenge. But like I said, there's maybe some indication that's perhaps curtailing a bit. Interest rates, specifically with our private equity-backed healthcare companies and other private equity-backed companies that we follow, a lot of them are highly leveraged and have high amounts of debt, and a lot of them like to make bolt-on acquisitions using debt financing, and that's obviously causing a bit of a concern. Maybe not even so much from the interest rate environment itself being elevated from where it was 12 months ago or 24 months ago, but also the access to capital. Banks are increasingly becoming more and more conservative, as well as just having less ability to lend due to just changing environments. So that's a bit of a concern for us, but I do still see a lot of our clients finding opportunity to find financing, specifically the clients that have good solid balance sheets, good business models, and good success and good management teams. And then I think the other thing is inflation, and I think again we're seeing some indication that maybe inflation is getting perhaps a bit better, but until we see a big change there, I think we're continuing to monitor what inflation might mean overall to the economic picture, including the middle market. So I'd say those are consistently the big three things that we follow, and I'd say those are current views on where they're at.
Thank you. And if this looming recession did happen, how would that affect the investing environment?
Yeah, I mean, I think a recession, sometimes from a private equity perspective, might not be the worst thing. Typically people grab, headlines related to, Fortune 500 companies, publicly traded companies. They look at, S&P 500, NASDAQ, and other things that, are really public company related, not private company related, right? So, I do think, if a recession occurred and maybe there was some easing of multiples and perhaps more appetite of sellers to sell, I think there's probably some opportunities out there for opportunistic funds to make acquisitions that perhaps at a slight discount, or maybe earlier than they would have expected to, based on the life cycle of the target. So, I think there could be positives in the recession for private equity groups, but overall, it's hard to tell until you're there, in reality, until it's over, to know if you made great bets, or if you kind of used your data and made incorrect decisions. So, I suppose with anything, time will tell. But again, I think we learned during the last recession, the late 2000s, that some private equity groups thrived and others really struggled to make good investments.
Yeah, that makes a lot of sense. And Rick, I want to thank you as always for joining me today on the Becker Private Equity and Becker Business Minute podcast. Thank you.
Thank you.